Let's get down to these Loretta Mester comments. Loretta Mester, very hawkish, obviously. How do you see this messaging impacting the markets right now? How do you see the Beige Book impacting the markets? They seem to be really fueled by AI.
Yeah, absolutely. In fact, President Mester, I think, has a pretty clear bead on what's happening to the concerns of the FOMC, which is inflation has been incredibly persistent, even though the economy is slowing down. And I think what we're going to learn from the Beige Book is that a lot of the market people have been hoping that, well, maybe the banking crisis will cause banks to contract their lending. But so far, several Beige Books have told us that bank lending has slowed down only because there's a slower demand for loans, not because the banks themselves have been contracting supply. So all of that packages together to tell us that the Fed is going to be pretty clear in continue to raise rates because right now the slowing economy isn't doing its job of slowing inflation.
So let me ask you a question, and this is a question I was wondering myself. Isn't the rate hikes, these rapid rate hikes, isn't that creating some of this economic uncertainty that she's concerned about? So isn't it kind of a cycle where we have economic uncertainty, you raise rates, and it creates more economic uncertainty?
That's a great point. That's really sad that the Fed itself can't communicate clearly what its intentions are. In some ways, it doesn't give us a reference rate to say that, look, this is where we think rates need to go in order to slow the economy, and we won't put it there if the economy slows down ahead of it. But we don't. I think a reference rule like the Taylor rule tells us we need about 6%. And I think the Fed should be very clear and say, instead of saying we're data dependent, to give us some clear insight into what they're thinking is needed to slow the economy.
All right, got to talk to you about the debt ceiling as well. Generally seen as a positive for the markets. But yesterday, we saw the Dow finish in the red, the S&P finished flat. Is that a sign of doubt this deal will actually happen?
I think people are getting fed up with the fact that the United States government goes through this kabuki dance every now and then. And I think the global investors out there are telling us, you know, get your act together. If you are going to show us a model of democracy for the rest of the world to emulate, you cannot have this kind of nonsense every now and then where the politicians get together and say the minority party just holds hostage this debt crisis and holds hostage default by the U.S. government. So I think the uncertainty that's being caused by this dance is really a function of the democratic government that we have, where the minority party doesn't want to give up the privilege of leveraging and holding hostage the debt crisis.
So, Bill, one more question. You had your big Milken conference just a few weeks ago. Were they concerned about the U.S. credit rating? Was that something that was being discussed? And how real do you think a downgrade is today?
I think the main concern about the fiscal situation is the fact that the debt path and deficit path is on an unsustainable trajectory. And I think the discussion behind the scenes was that if they only deal with discretionary spending, which is what the Republicans are dealing with, that's not going to be enough. And Fitch may actually show us that by lowering our rating from AAA to AA.